Hi everyone and welcome to this new video. Today we will be comparing two of the most talked about income ETFs, JEPI and QYLD. Both are designed to generate monthly income. They are what we call covered call ETFs or income ETFs, but they are not built the same and they are not for the same type of investors. So I hope by the end of this video you will clearly know which one fits your income goal and which one doesn't. Before we go any further, I would like first to go over what does it mean a covered call strategy. So for example, if you own the shares of Google, you own 100 shares of Google and Google is trading at $300. So by owning those shares, you have the right to sell a call option. So when you will sell a call option, what does it mean? Is you set in your mind a specific price that would be called the strike. And you tell the market, if Google, for example, exceeds $305 by the end of the month, it's yours. You're going to take away my shares and I'm willing to sell for $305. And if it didn't reach the $305, I get to keep my shares. So you will ask yourself why I'm doing this. I'm doing this because I'm getting a premium. When I'm selling the option, I'm getting a premium. So let's imagine that I'm getting a $200 premium. So at the end of the month, if Google exceeds 305, those shares, I lose control over them. They're going to be assigned. They're going to go to that person that bought the option. And so I will be selling at 305 and I will be keeping my premium of $200. In all scenarios, I'm always keeping the premium. So in this scenario, you gain $200 and you sold your shares for 305, making a little bit of profit. And if Google stock does not reach $305, then I keep my shares and I keep the premium. So see the best that could happen for someone selling a covered call is to keep the premium and keep the shares. Because if the Google, for example, shoots up to 315, that's not really ideal for you because you just sold your shares for 305 and you gained only $200 premium, which is technically, it's like you sold Google for 307 while it's trading at 315. So you see here, you're capping your potential for that income. So the strategy is usually works in what we call where the stock is just moving up and down, but not really much, stagnant over a period of time. Then the income strategy covered call works really good at that point because you just keep holding on the shares and collecting the premium. If the stock price shoots up, you're technically losing the upside potential and you're losing your shares. If the market's bottoms or there's a stock, Google stock goes down heavily, you have some safety cushion with the premium that you kept collecting. So that's the covered call strategy. It's not perfect, but it's ideal for someone who wants to collect income. Thus, those income ETFs have now existed and flourished everywhere. So the covered call ETFs, they allow people to have access to this strategy without them using it themselves. There is a manager that uses the strategy on large number of stocks, and you collect the income or the premium that manager collects during the specific period using that strategy. So here a comparison between these two ETFs. In terms of index, JEPI tracks the S&P 500 low volatility stocks. So low volatility means simply that the stock itself, there is something we call the beta. So the beta is the sensitivity to the market price. So if the market goes up by 1%, what usually happens to your stock? The beta is just calculated over the past. It could be calculated over the past 5 years, the past 10 years. And what it tells you, if it's equal to 1, it will tell you that this stock, if the market goes up by 1%, that stock will also go at 1%. It has the same reaction to the market. So a beta of 1 is equal to the same reaction of the market. So when you hear someone telling you JEPI tracks the S&P 500 low volatility stocks, that means that it's composed of stocks that have beta less than 1. So this JEPI uses actually those safe stocks low volatility stocks to sell options on them and accumulate income. QYLD, on the other side, is in a completely different spectrum. Actually, it focuses on NASDAQ 100 stocks. So it is tech stocks. So you have their high beta stocks, and they're using the covered call strategy on those tech stocks. JP using covered call strategy on safe, stable stocks. So in terms of the strategy, both of them use covered call strategies, with QYLD being a little bit more aggressive using at the money call option. If I go back to my example for Google, what it means at the money, it means that I'm willing to forfeit, let go my shares. Let's say Google is trading at 300 in a next week. I will put also a strike of 300. So I'm not making any profit on the stock itself. I'm just trying to maximize the premium, because the lower the strike price, the higher the premium, because the chance of the shares being assigned becomes really high. So if you're selling a covered call on Google and the Google is trading at 300 and you tell people I'm willing to sell it at 320, there will be a lot of people who will line up for it, because the chance that the stock reaches 320 by the end of the week is really low. However, if you tell the market, I'm willing to sell it for a 300, the probability is really high, so people are willing to pay more premium. So QYLD really targets more premium. They're using at the money call option, while as JP is using a covered call strategy, but less aggressive, using a strike price that's higher than the current price, the way we call out of the money. In terms of yield, JP offers an estimated yield of 8 to 9%, and QYLD has an estimated yield of 11 to 13%, which is actually good, because when you look at QYLD, they're using tech stocks, and premium are very generous when it comes to tech stocks, where they are more volatile. That's why the premium they collect is much higher. So QYLD has a higher attractivity there, allowing you to get a much more uh, estimated yield. Whereas JP, with stable stocks, you can't really get a lot out of the premium. However, you still get a decent premium. So the ETF is still able to generate 8 to 9%. So you have the assets. JP is much more larger than QYLD. ETF, it has assets under management for 8 billion, whereas JP has an asset under management for 41 billion. So it's much more liquid. However, both are very liquid if you're trying to buy and sell in the stock market. Recap, the most important point to keep in mind is that QYLD focuses on NASDAQ stocks, so high volatility stocks, and the portfolio is comprised of those NASDAQ stocks, and they are selling at the money, maximizing the premium for you. However, because they are selling at the money, they are letting go a lot of possible capital appreciation. As I mentioned, if Google is trading at 300 and you're selling for a strike of 300, you're not making any capital gains there. So that's why this strategy really limits any capital gain, however, maximizes the premium. So keep in mind when you invest in QYLD that you are maximizing the income. So it's better for someone for whom the income is much more important than capital appreciation at the end. When we talk about return, the total return is the income that comes from the premiums and also the price performance. So QYLD will have a very it will have almost no price performance. However, the yield will compensate the monthly distribution that you will get, will further compensate the fact that the ETF doesn't really gain any capital or price performance. For JP invests in dividend, in diversified S&P 500, mostly dividend stocks, and it's using the strategy out of the money. So you will get some capital appreciation plus the income that comes from the dividends that are held by the ETF and also by the premiums that are collected. QYLD will be almost 100% just premium, because not most of the stocks that are in the NASDAQ 100 do not pay dividends. So most of your income will come really from selling options, the premium that it's gained from options. In terms of performance, as you could see here, both have great performance, and QYLD takes advantage of the past 3 years tech stocks have done really well. So QYLD had a performance of 14.89 average annualized return. We're talking here total return, so including dividends, 14.89 versus 9.90% for JEPI, which is expected. I mean, tech stocks will bring more, usually in better performance than JEPI. However, JEPI is more stable, as you could see, whereas um, QILD will tend to go with the tech stocks. If tech stocks are doing well, then the fund will do well. JP is much more defensive. Having dividend stocks, they're usually dividend stocks perform well, whether in a recession or in a bull market. They tend to perform relatively well, and they tend to be much more resistant to cycles like a recession cycle. Tech stocks tend to depress really when there is a recession. So as a final note, choose QYLD if maximizing current cash flow and yield is a priority for you, even if it means capping your potential. And GP, choose that one if you have a balanced approach, you're more conservative, you would like to hold indirectly just quality, defensive dividend stocks. You don't want stocks that are volatile, then JP for sure is the one you should look into. Thank you very much. I hope this video answered your questions. If you have any comments, please do not hesitate in the comment section to write down your question. And don't forget to subscribe and like if you like the content.